Okay. So when let's say VC invests in the very early stage round, like for example, Sanjay mentioned that he puts $100,000 to $250,000 in the early stage, and then he says, you know what, the winners get $1 million to $2 million or whatever. You'll double down on the winners.
Right.
But if you don't, then that creates a signal saying the VC is not interested anymore. What does that mean? Tell us a little bit more about what are the advantages, disadvantages of it.
Sure. So typically startups raise multiple rounds of funding. Typically raise a first round of funding, which is a seed stage round, then go on to raise Series A, Series B. So if a participant in the seed stage round does not participate in the Series A stage, and they're typically investors who do participate in Series A or Series B stages, this typically signals that their interest level in the investment is not very high, they're not very confident in the company, and therefore it does not send a very good signal to other investors who would probably explore that opportunity as well.
Okay.
Does that answer the question?
Does that help? I'll go into a little bit more detail. We'll probably need 2-3 people to come in. But
Sure.
why don't you go ahead with SAIF and then we'll get to the next level.
Sure. So starting with SAIF, we'll probably start with the name first because we get questions around what does SAIF stand for? Is it Salman Khan, Saif Ali Khan, or is it a Middle East fund? So SAIF started off as a SoftBank Asia Infrastructure Fund in China in 2001. We started off investing in China in 2001, started investing in India in 2002. So we are a 10-year-old fund, have invested in over 30 companies in India so far, and invest across sectors and across stages. So out of those 30 companies, 10 are what we call early stage investments or tech investments. And those are 10 logos that you see in our investments, and that is the part that I'm going to talk about today. So on the early stage side, to take you through our early stage portfolio, on the right-hand side, you see 4 of our older investments on the early stage side, invested in Make My Trip, 197, Just Dial, and Home Shop 18. These 4 investments were in the 2005 to 2009 time frame. And then in the past 18 to 24 months, have made 6 more investments. So invested in Zovi, Inkfruit, and First Cry. Those are 3 of our e-commerce investments. Then invested in iStream, which is a video destination site where you can watch TV content and movies. Invested in PropTiger, which is a real estate portal, also provides offline brokerage services. And lastly, invested in Exigo.com, which is a travel meta search engine, also expanding into the broader travel content space. So currently investing from our 4th fund in India. This is a $350 million fund that we raised early last year, and it's a 10-year fund. So have an investment time frame of 7 to 9 years. And in terms of sector focus, we are pretty sector agnostic. Anything that has a tech component that can help the company scale up well in a 7 to 9 year time frame, we look at those businesses. Just would like to take a minute to explain how the team functions. So we are a 7-member team on the early stage side. Ravi is the managing partner of the fund, is also the sponsoring partner of our early stage investments. And then the 6 of us have specific focus areas where we go deep into different sectors, spend time meeting companies within those sectors, and also develop our hypothesis on that sector. And that helps us look into multiple sectors. So in terms of ticket size, our smallest investment has been 500K. Are open to doing investments up to $10 million in the first round. In terms of how we help our portfolio companies, so there are 3 things that I would mention here. Just in terms of our older investments, Make My Trip is a company that has gone IPO. Just Dial is a company that has filed for IPO. So we are one of the fewer funds in India that have seen the whole Series A to IPO story. And therefore, we bring that experience to the table, help the company both in strategy, on hiring, and as well as tactical things as well. Then within the portfolio, I have a strong network of older investments, and those companies help our newer investments as well. So to give you specific examples, Deep, who's the founder of Make My Trip, is also on the board of Zovi. First Cry recently went live on TV with their advertising campaign, so they spent a lot of time with Make My Trip CMO Mohit. So those are some of the ways that portfolio companies help each other out. E-commerce portfolio companies have monthly calls where they discuss broad metrics, spend time discussing qualitative stuff that they've learned over the past month. And lastly, we are a $350 million fund, which is one of the bigger funds in India. So are capable of investing capital in multiple rounds, do help in keeping the company capitalized.
Questions? Yeah, go for it. Yeah. So my question was, one is that, say after the first round of funding, if for the second round, say we choose another company, another VC, what is the reaction in general, and do you help us make these connections or not?
Sure. The question is whether for the second round of funding, the company looks out for a second investor, and do we prefer that, or do we help make those connections as well? So typically how it works is in the next round of funding, we do encourage companies to bring a lead investor for that round, and this happens across companies, helps across funds, which helps us understand what the market situation is, what the interest in this specific investment is, and get some market validation as well. And then typically we do participate in that round, and the company does bring in a lead investor. So we're pretty open to that.
Okay. Yeah, go for it.
Are there any instances when you actually merged two companies from your portfolio because one of them was not doing so well, but they had better synergies with the other?
The question is, has there been a scenario where we have merged any of our existing portfolio company with another portfolio company because one of the companies was not doing well and the other, or there were better synergies of working with them? So this is our early stage portfolio. These 10 companies haven't had such an instance occur till now.
I think we'll have enough time. Okay, last question. Yes, the gentleman with the specs and the French.
What is the success ratio of your investment? How much percentage succeeded at the good exit?
What percentage of your companies have succeeded with the good exit? You have two exits.
So that's a terrific question. Those are the 4 of our older investments, and they've been doing pretty well, fortunately. Make My Trip, Just Dial, 197, and Home Shop 18. And then the rest 6 of them have been made in the past 18 to 24 months. So they still have some way to go before we say whether they've been successful or unsuccessful.
Hey guys, just one question. Yeah, go ahead, the gentleman behind you, yeah.
Okay, despite all this due diligence and the time that you take to invest, why is it that many of the investments fail? This is a question not that you said.
Get the question done.
So in terms of due diligence, you cannot... So the question is, in spite of all the due diligence that you do and take time to make investments, why do some of our investments fail? And if we talk about due diligence, in due diligence we are not removing the risk of failure. What we are typically doing in due diligence is validating whatever we have learned from the company. We do financial due diligence, legal due diligence, business due diligence to just learn whether all the right contracts are in place, whether the financials are true or not. And those are things we do, but inherently we know that we are taking a risk, and we can't really remove the projections even if we do as much due diligence as we want.
Okay, actually that's a question for entrepreneurs. But thank you very much, Abhimanyu. And the other people, okay.